Oh my God, Jason, what are you wearing?
I went to your wardrobe.
Are you sleeping over? What the heck?
If I was sleeping over, I would have woken up 5 minutes late too.
That's a good one. I like that. Yeah, we did not plan the outfit look-alike. So, Mark, you didn't get the memo?
There was no memo, I guess.
There's no word for blue in French.
The French national team is called Les Bleus. That's what they call their soccer team.
Oh, my God. Good to see you, gents. How was the week off? Pretty good? Yeah?
Yeah, pretty good. Pretty snoozy.
Yeah. Well, it's the late, Mark, as you know, in the 4 days, it's the lazy part of the year, right? Right July 4th time, it was watching Glue for a few weeks in the summer.
Sitting on your hands time.
Yeah, that's all right. You know, I noticed the OCC system-wide volume has been well under average the last several days. Like, if they do 44 million contracts, it's been 32, 36, 39. So it's definitely been light, I think.
Mm-hmm.
So I'm seeing it more in, from our end, and our volume's been good, but it's still definitely a little bit lower than normal, I think. Yeah. And people are also dealing with a slightly lower implied volatility environment, so we should probably touch on that as well. What kind of things are you guys seeing? Are you seeing anything similar?
Yeah, I mean,
in terms of the volume, I definitely obviously agree. We're all seeing the same thing here. I think, ironically, though, like I'm seeing markets get, maybe it's not so ironic. It does tend to happen that, like, as price drifts up, as stocks, go higher, people are providing more liquidity. Like I'm definitely seeing tighter markets out there, particularly in SPY. It seems like the volume's tending to concentrate a little bit more in like some of those top ETFs and indices. As volume goes down, that holds a little bit more. But yeah, markets are as tight as they've been in SPY in the last 3 months.
Yeah, well, it's hard for them to get too much tighter than a penny, I guess, but definitely.
But in terms of vol terms, like the vol spread on them is like 0.2 of a click wide.
Wow, that's what. Now, what do you think why does that happen in the lower volatility? Just less chaotic. They can kind of keep them nice and sane. Is that the kind of the idea?
I think it's kind of like, it's like flood insurance. Everyone lowers their price every year, and then all of a sudden the flood comes, and then everyone has to jack up their prices again. So I think what happens is like volumes go down as, the vol comes in. People kind of get more confident. They get more confident with like smaller moves. But then as volumes go down, people tend to carp for a little bit, the less edge on every single trade.
Right.
So you kind of see people selling edge cheaper and cheaper in calmer markets until they get shaken out like the flood comes.
Right. Okay. That makes sense. Jason, what you seen anything interesting?
Yeah, I agree with Mark. Historical volatility, last time I checked, I think it was yesterday actually, historical volatility was down to like 11.07, and at the money 50 vol for 30 days out was at like 11.4.
Wow.
It's very, very, like when Mark is saying very tight, I think there is no variance risk premium. Long gamma is probably the way to go. There's a lot of fundamental catalysts coming up, like every CPI now is kind of more and more relevant, and unemployment. And there hasn't been a lot of event fall for it, and rightfully so. I mean, in the past couple of catalysts, there hasn't been much activity. So I think people are getting a little complacent. As far as the volume goes, Voland has been showing like a strong like impulse in the beginning of the day, but it takes a while for like especially 0DTE SPX to kind of shape up. And then after that, it's like boring for like the next 3 hours. I have nothing to say in my like little updates. I'm like, this is the same as it was last hour. Like,
yeah, sorry.
it's the same. Just wait until dealers have to hedge at the end of the day.
Yeah.
Also, I know that that JPM collar gets a lot of play, on Twitter and stuff, and that's expiring tomorrow, so it might be something to talk about. But right now I think their call strike is at like 43.20, and we're above it. So that makes that negative Vanna. So it's probably going to act as a floor for a while. So
Is it?
at least
Okay.
for the next couple of days. So if you want to sell puts, sell cheap puts. There you go.
I'm not
The vol environment, speaking of that collar, I was just looking at that yesterday. It has a pretty decent implications rolling at the end of June compared to rolling at the end of March last quarter. So the call strike out of the money that they're like, when they sold the 4320 last March 30th or whatever day that was that they rolled, that strike was about 6% out of the money from where we were trading. Today, the cost of that 520 put spread only gets them a strike that's like 4.5% out of the money. So their upside is like 25% less, 4.5 versus 6%, just given this vol environment. Shape of the curve looks about the same. It's really just like, a downward shift of the curve that is bringing that bring that call strike in.
Right. And when they do that trade though, I wonder if there's a point where they won't do the trade because it's 2% out of the money. I mean,
no, they have to.
They have to do the trade, right?
Yeah.
Yeah, they have to.
Jeez.
And they actually just launched an ETF filing yesterday that they want to introduce an actively managed version of that, which I wish I was as big as JP Morgan because I sort of do a flavor of that where, if you roll it monthly rather than quarterly, you change a lot of your rebalance timing, risk there. And instead of 4 resets a year, you can split up the position, dynamically roll it across, more intervals. And they're going to do it monthly.
Yeah.
ETF.
The exchanges are happy about that.
Oh, right? Yeah.
Well,
4 times the volume or 3 times the volume.
A couple weeks ago. Oh, sorry. Go ahead.
Nope.
A couple weeks ago, though, like the 1 week had like a 5% on the June OPEX week because it looked like there were a lot of like call strikes that went into the money and kind of accelerated markets up to this SPX like 4,400 level. And I think if you were to start rolling monthly, you would lose quite a bit because you wouldn't have that 4.5% buffer. It'd be like a 1% buffer, right?
Yeah,
1% per month or something like that buffer, right, Mark?
Correct. And the difference would be too, though, is my understanding is that it's going to be laddered. It's not like you do the whole position 1%. It's that every month you sell a 12th of your position, and so you're like still going out a year, but you're only you're fractionalizing your position.
Oh, interesting. Okay.
Because I agree. I actually think that's a much worse proposition to time that too short. I mean, it's like setting the optimal duration for an overwrite strategy. That if you come too short, then you're just going to get whipsawed.
Right. Interesting. So what are you guys doing in these low environments? Jason, you mentioned long gamma. I know how I did it in the old days. This was my least favorite time to trade in. I didn't particularly like being long gamma and paying theta. So I think we probably ended up being more time spread diagonal. So we'd sell a little front month and buy a little Vega going out a little bit and just keep us on the right side of the Vega curve. You guys, Mark, did you do anything differently, or what would you guys be doing? And what are you doing now in the managed money world?
I think it's the same kind of challenge, right? It's like in low vol environments, in some ways the lowest vol is also the heaviest vol. And maybe that's a riff off Jason's comment about how when vol's low, it can, it's never low enough when it's low and it's never high enough when it's high. But yeah, I think managing that kind of carry in this environment, whether you do it through time spreads or whether, even within a month, I actually still like regular verticals, in this type of vol environment. I actually like a condor in this environment in the medium term, because I think to Jason's point earlier about some of that, event risk that's still on the table, but the market's not pricing in, 90-day condors and SPY are trading about 1.2% of their stock price. Now, for reference, they were 2% of the stock price. They're almost twice as expensive 3 months ago.
Okay.
So yeah, I think if you see any movement in the next 90 days, some of these iron condors or whatnot, like, are actually a decent play given how cheaply they're trading.
Mm-hmm. So you're not shorting the iron condor, right? You're the other way.
I'm talking about buying a call spread and buying a put spread. I'm talking about going long gamma.
Okay.
So
Okay.
strangle.
Got it. Interesting. Jason,
So-
what kind of things are you able to take advantage of?
So the things that I like to do, because I look at the term structure as well, because the deep out of the longer term, we're still talking, higher teens implied volatility. Where in the shorter term, we're looking at like those low teens. So there is quite a steep contango. You can go long or short gamma in like the 5-6 month range. Do a sold condor, credit condor, like 5-6 months, and then do a long gamma for the shorter term. Make sure that your long gamma is a little bit cheaper. But that term structure really kind of can present some opportunity. Like, I guess you could almost say like hedging in the out of the money, or the deeper tenors of the option plane.
Okay, so you're saying, just so I'm clear on that, you're buying front month sort of gamma, selling farther out Vega, I guess.
Yeah.
I would take the other side. I don't think it's a bad trade, but I think I personally would take the other side of that trade.
Really?
I think
we got an argument.
I think this is what makes a market, but I think I like being long back month, selling front month against it to finance that right now.
Huh.
I think
even though the vol structure across time is contangoed, which means
agreed, and I think
higher.
What was your what's my further out timing? Did you say?
Well, I said the farther out term structure is higher vol than the nearer term, and you're happy buying the higher term. I'm sorry, the higher vol in the farther term and finance it by selling cheaper vol in the near term. Is that what you said?
Agreed. Because I think this is like a case where I feel more confident in the dollar amounts that we're talking about here, right?
No.
Like, it's not necessarily about vol here, but I think I would feel more comfortable selling activity in the near term, using that to finance my medium term long and stay protected, on, a move over the course of the next quarter.
Interesting, Jason, and you guys might put the trade up. Let's go.
Yeah, let's put it up.
We might have to set up an OTC here.
Yeah, I mean the whole thing for me is just that big Vega difference, and the fact that historical volatility right now is super low for the closer tenors, compared to the implied volatility. But there seems to be a little bit more space and a little bit more VRP in the farther tenors. So now I'm kind of curious now. Mark, set up.
We'll paper trade this one.
How's that sound? All right.
Right.
What do you got for me, Mark? Do you want me to propose?
Sure.
I'm pulling out all of our mutual friends platform ORATs to get an ideal thing here. We'll just do like a calendar spread. How's that?
That's fine. You pick the terms, Jason, and Mark will more or less agree to it.
You can talk to Mark.
Quite the trade. I'm a guaranteed buyer. What strikes you putting on? Seriously, like that structure, low vol or high vol, I actually tend to like strategically as like an asset manager, right? Is that like I like being long back month and selling nearer term against it. So like long-term protective put to sell calls to overwrite against that, and to finance the long-term versus with being short the short term. So, but I do have a bias towards this.
Yeah, there's a price though, Mark, where you won't make that trade. It's just too skewed out of whack, right? It's too cheap in the front, too high in the back. Is that accurate?
Yes. And of course there's a price for everything. But I think as an investment management strategy, it might be different than like a pure vol, trade, right? Like if you're doing this as an overlay on equities, you have a different payoff structure than if it's a pure vol trade.
Okay.
So I qualify my bias as being related to overlays.
Got it. Okay. Let me throw a question up here for you. Just look in the screen. See if we can answer that. You guys see that?
What do you want? Do you want SPY?
Let's just pick SPY if that's okay.
Okay.
What kind of deltas, like in terms of what delta of a strike? I think if that's the question, I think my normal like selling range, and this is good for like covered calls, this is good for risk reversals. Like I like anywhere between like the 30 and 15 delta range. When I do like risk reversals, I lean more towards like that 15 delta. Covered calls, put rights, like I probably am a little higher in the 25-30 range is sort of my rule of thumb selling range.
So on the short side for you're 30 to 50 delta. Is that what you said?
30 to 15. Sorry,
15,
like anywhere.
Yeah. Okay. So 1.5, not half 100. Got it. Okay. Yeah. You stay away. Excuse me. You stay away from that at the money. So you kind of push it up a little bit.
Yeah, and I think that's somewhat like I think on the overwrite side, I think that 30 delta 30 days is a super good just rule of thumb if you're doing that kind of trade.
Yep.
The 15 delta has a little more sauce, and I know Jason and I have talked about this before in terms of that like Vanna inflection point. So like as a skew trade, 15 delta I think has a little bit more of like science behind it.
And where's the put out in farther time? I know you said it, but I forgot now. What delta is that put farther out roughly?
Like if I'm buying puts to sell calls in like stock hedge, usually I actually say that's like similar delta, like honestly like 25, 30, like, sometimes that's subjective based on like a price number that you say want to protect X dollars, but I honestly think they usually fall in that 25, 30 delta range too.
Got it. Okay. So it sounds like, well, because of the time, you're not getting exactly zero cost. You're probably paying a little bit, and that's why you're rolling the short call out every time, right? Every month or every weekly.
Bingo.
Yeah.
So usually, that ratio changes, but like the front month 30 delta call relative to the back month 30 delta put, like in spiders, that number usually is in the like 11-12% range.
Right.
So, if you could sell 12 at 11%, you're obviously more than paying for it. But that's the short-term risk premium that you're getting.
Okay.
Yeah. So we could follow this. This is not investment advice. Both Mark and I guess, have to say
neither of I are making investment advice.
Because this in my mind, this would be an actively done trade because I would be rolling that long put back every single time. But anyway, according to Orats here, my number one ranked short put calendar, giving me the most edge because I want it, is a 439 calendar, which is a little bit above the money.
Yep.
Put calendar. It's saying that it's $7.51. I'll sell it to you. What do you think, Mark?
Where you're buying the front month, it's giving you the most edge to buy that 439. That's because front month skew is definitely like the upside calls are totally been smushed compared to back month. So I suspect that's why it's.
Why do you think I would take this side of the trade?
Mark said he might want the other side. Mark, what do you say?
Yeah, I'm happy to take the other side, like just in general, but like to advocate, more to explain why I think they're picking the 439.
Okay.
Here's the upside skew is smushed in the near term relative to the long term.
Right. And that's why I was recommending the trade. That's why I would take this side.
All right. Well, we're going to put it on the books.
The 437s are $7.77 according to Orats.
Okay. So we're going to put it on the books. We're putting this trade up.
Okay, 439s. I'm happy to take the other side of the 439s just because I think that's a good point. And what'd you say? That was $9 something?
$7.51.
So the 439s is $7.51. Got it.
Yeah. Okay. You guys.
So the way our thing works is if we go up a little bit, you're very happy and not like moving much. You're very happy. But if we do tank, then I'm very happy. I don't know if I have us tanking by July 21st, but I mean, there's a lot of stuff in there and in between. So
Okay, so you guys email me the trade. I'm going to put it in TradeHawk and model it, and we're going to
Okay.
keep dibs on this thing. I'm going to give a little update on it.
all right,
And we'll
Sound good?
roll it come July 21st.
yeah,
Sounds good.
Yeah,
Just
near
email me
July
the trade.
21st. I'll roll.
Email me the trade. It's going to be like 1,000 lot or 100,000 lot. We're going to do something huge.
Whoa, Lex.
I only like to trade gigantic when I do it.
What, Mark? You're backing off now?
All right, one more question, boys, and I got a question about another product.
Put your millions where your mouth is.
Have a look at that question.
Okay.
Would you agree buying cheap convexity is a decent play here to hedge with interest rate lag? I definitely agree with that. Like, I actually think that's, that was my trade coming into this today was I like your 90-day out condor right now. Like, I think like that is to the upside or the downside. I think it gives you both. I think there's reasonable arguments for both. I think macro wise, things are going to change once the interest rate either pace or direction or like a lot of potential for uncertainty there. So I am a buyer of cheap gamma here.
Okay. Jason, any thoughts on that one? You need it back up there?
You just sold me cheap gamma.
I got to hedge somewhere. This is how you trade flow.
Hey, that's right. That's the whole thing. There's no edge without the H, right? It's called a hedge.
Well, no, I sold near term gamma, but I like buying the 90-day vol. Like I like.
Well, I put it out to December, so it's kind of all right.
Just send me the trade. I'll have it modeled.
No, I think right now cheap convexity is very attractive, especially near term. You kind of want to hedge with something, but yeah, I think near term cheap convexity is.
Jason, you know what Jason's gonna happen to Jason? He's gonna buy this front month gamma. It's gonna start like crackling like firewood at a bonfire. He's gonna start panicking and sweating and have to roll that out because he's losing so much money on theta, even though it's cheap, right? I remember those days. Okay, great. I got to sell something cheaper now to offset it.
Now I bought 11 ball. Now I got to sell 8 ball.
That's right. Now I feel better. Oh my God. All right. One last comment here. We got to go. Thoughts on SPX versus XSP versus Spider. Okay, and we'll take this up next time. But here's where I'm going. As you know, we talk a lot to SIBO, and it's their products, or not Spiders, but the other two, and they're really making a big push for XPS, which to me makes great sense for a retail trader. The XPS, it's a tenth of the
XSP. You mean
XSP? Sorry, XSP is what I meant. It's a tenth of SPX. It settles and trades exactly the same. So it's cash settled, it's European exercise, it's all the beauty of SPX without the huge notional, right?
Yeah.
What are we missing with XSP for the retail folks or anyone for that matter? How do we get that to trading 2 million contracts a day? Liquidity, is liquidity first, and it's kind of the cart in front of the egg problem here. We need to have people interested in it to make better markets, right? So have you had anyone ask me about this? Huh?
I trade on XSP.
You do?
I mean, the liquidity, yeah. If I need to, especially since it gives you much more granular risk management. I mean, if there is no liquidity on in the money options in XSP, but you pretty much get you get fairly decent executions, and the liquidity, like the 1 to 2 pennies you lose on liquidity, you make up much more in the tax rebate.
Yeah. That's what I'm hearing too. So here's the deal. I think the big push is the at the money XSP is pretty good. A couple pennies wide. The in the monies tend to be wider, than SPX. And you have to trade several more contracts in XSP to make an SPX, right? It's a tenth. So if you're at a place that's not charging you for contracts, that's not so bad. But if you are, then you get eaten up, on the other side. I think they're doing a rebate too for XSP if you're under 10 contracts. I think there's no fees for that, if I'm not mistaken, but I got to look into that. But you use it, Jason.
Yeah, I like it. I mean, it's
Okay.
it's like you said, it's got all the tax advantages of SPX with all the capital advantages of SPY.
Got
And you
it.
don't get that fear. One thing I don't like, especially I hear a lot of people trading 0 DTE SPYs. And if you're getting close to that end of the day at like 3:30, 3:45, you have that chance of the brokerage executing executing,
Taking you out.
taking you out for
Yeah.
risk management purposes. That's kind of scary to me. I don't like that.
Okay. All right. Well, stay tuned. We're going to keep pushing XSP. I like the idea, but I think they have some work ahead of them.
Well, they need to get
Liquidity
more
begets
liquidity.
liquidity. So like the reasons are obvious. You just need to get that virtuous cycle going of
Right.
Right.
dealers that want to chase customers and customers that want to chase dealers.
Yep. All right, boys. Happy 4th Independence Day, right? I hope you're doing something with the holiday. I love this. I love it on Tuesday, by the way, right? Because Monday's a non-day. It's a half day in the markets. It's really not a half day either. I'm probably gonna sneak out at 10.
Mark, do they celebrate it in France in some way? Because France kind of was on our side there.
They were for sure. Their own Independence Day is 10 days later. So
it's Bastille Day, right?
Bastille Day, right?
Mark's gonna have a beanie, one of those little, what do you call it? Not a beanie. What are those called?
Beret.
Berets.
Oh, thank you.
Beanie.
A beanie. I thought it was a beanie. It's a beret.
That was worse than the cold open.
All
I think
right.
we were all part of.
Very good. Good seeing you guys. Have a good holiday. We'll talk next week.
All right.
Happy end of quarter. Happy trading.
Yep. Oh, yeah. Happy trading and end of the quarter. All right. Have a good day. See you guys.
See ya.